All right. So we just wanted to do a class here, just to kind of do a podcast style to talk about credit and credit repair. I've got my buddy Ryan Dorman from the Dorman team over at Evergreen Home Loans, who has been a partner of ours for many years and has helped many of our clients get their credit in repair so that they can buy a home. So today we're going to be talking about all the tips and tricks that we've learned. We are not credit repair specialists, so let's just get that disclaimer out of the way. Results may vary on this thing. Occasionally, sometimes you do some of these tips and your credit score actually goes down for a half a minute. So sometimes that happens on your way to repair. That can happen. So don't be calling us and saying, hey, I did what you said to do, my credit went down. I am warning you that results may vary, but these are things that we've seen over the years that have really helped people. And we want to share them with you today. That there's a lot of folks that I know that I talk to in my database that they want to buy a home and they're just afraid, or they feel like the credit mountain, if you will, is just too high to climb. So Ryan, I appreciate you jumping on with me today and chatting through this. I think one of the first things I want to talk about is like, what's the big deal about credit? Why is it important to get your credit in check? And sometimes a lot of people think their credit's either worse than it really is, or sometimes they think it's better than it really is. So, what's the big deal about credit?
Well, I appreciate you having me, Travis. I have a lot of respect for you guys and your team. Just do a phenomenal job in the industry, and I appreciate you having me here. Just real quick before I answer that question, I want to make sure, just for disclosure purposes, I do have to have my MLO number out there. So my MLO number for the record is 269939, and I work with Evergreen Home Loans on the Dorman team out of Puyallup, Washington. So, but your question, what's the big deal with credit? Why is it important? There's a lot of areas in our lives where it can help us or hurt us. Yeah. And obviously, I work in the area of residential home loans. And so, of course, I'm going to be talking more about that. So, a lot of people want to know, well, what's most important about the credit? Some, when it comes to buying a home, many would often say, hey, it helps us get the lowest rate possible, which is true in some portion of that fashion. But, I would venture to say that probably one of the biggest benefactors of having a really good credit score is the part of entry in getting into real estate. And, if you talk to anybody that's owned real estate over the years, it's one of the largest benefits, or the ability to get in allows you to start building some equity. And, that's one of the fastest ways, and most talk to financial advisors about this. I've got several that I work with. Yep. And some of them I say, hey, what would you do if you could turn back time? They said, well, I would have gotten my credit up and I would have bought in real estate sooner, because we know that equity builds over time. Just a couple kind of going into, monthly payment. This is important to look at. So I ran a little scenario before this call just to kind of do a quick little comparison for everybody. And the scenario I ran was an FHA loan with, say, 3.5% down, a credit score of 640, as opposed to somebody that was to get a 700 credit score. And what would that look like? And really, the monthly pay, the rate was only an 8 difference, and the monthly payment was only about $23 difference. That's a 640 to a 700. Right. Now that span can be different depending on the market and what the industry at the time sees as risk factors. Credit score is one of the pillars of risk associated with getting a home loan. Yeah. And I think it's important to look at that it's not the most important thing when it comes to qualifying for a loan. And we'll talk about some of those things on your credit that they look at, not just the score, but what's actually embedded in that credit, what makes that credit report. Yeah. So we'll dive into that a little bit. But so that's the big deal. It's the point of entry into getting into one of the biggest investments you'll make in your life, probably aside from getting married or having kids or going to college. Kind of a big deal.
I couldn't agree. Like, just real estate's probably the quickest way to build wealth in this country, and you can get in with a fairly minimal investment. I mean, shoot, even as first-time home buyer, you can get in with down payment assistance programs and things like that. And I agree. If you can get in early and do that, I'd love to touch on maybe rent versus buy. But I do, before we dive into that, I wanted to ask, we know credit's kind of the point of entry. What is the minimum, we're talking about credit score, and that's an interesting difference, 640 to 700. You would assume 700 is going to have a much bigger impact than 640. But there is a threshold where you really want your credit above a certain amount before you start really going after a home loan, because at some point, whether it's 550 to 6, at some point there's a threshold there where you definitely want to cross that line. What is that threshold? Can you tell us, Ryan?
That's a great question, Travis. And it really is going to depend on the loan program and the qualifying ability for that program.
Okay.
So, VA, FHA, USDA, those are called govy loans, if you will, government, supported loans. Then you have conventional products. And usually in the govy loans, you're going to have a little bit more loose guidelines for that. Now, pre-COVID, we could do scores as low as 580. Well, during this whole pandemic we're dealing with here, of course, the market is a little more skittish and a little more concerned about, some of those risk factors, including credit score, rightfully so, right?
Yeah.
And so right now, if you can get a 620, 640, that's kind of really the bare bones there. We could potentially get an automated approval at a lower rate, but or lower score, but that's typically your point of entry is like a 620, 640-ish.
Okay.
Does that help out?
Yeah, no, I think that's great for the people that are watching this. I think it's good to understand that. And one of the things that we can touch on when we dive into kind of what it takes to get your credit score up and repair your credit later is, I'd like to touch on later how much time it's going to vary from person to person and case to case, but just in a general idea, we can tell people today, like, normally I see 6 to 12 months. I feel like, we see we can see some really big strides in credit repair. So depending on how bad the credit might be to start with, I mean, sometimes even 90 days is all it takes, so I think a lot of people are scared. Maybe they have a 550 or maybe they have a 600, but they think that's really, really bad, or 620 and they think that's bad because they've heard 700 or 800 or something, and they don't realize that they're just right on the edge of being able to qualify for a loan, and it wouldn't take that much probably, or even that much time, depending on their situation, to get right. So I think that's an important thing to think about as we're talking about this today is, I just want to encourage people. I feel like so many people are gun shy. They're afraid to get the process started. And one of the things I always say is just call the lender, call your lender and just figure out where we're at. We had this with a client the other day, or, last month, we had that conversation, and good for them. They finally, they picked up the phone. We did a conference call with them and had a similar type of conversation we're going to have today. And they felt encouraged by it. They knew they had some work to do still on their credit, but at least they had the tools to go after that, and they had benchmarks that they could effectively hit rather than just never knowing, right? And the sooner that people can figure that out and put a plan together, which is something that we can help them with, if they don't put a plan, they're going to be in the same place a year from now than they are today. If they put a plan together, they could be buying a house a year from now, which is incredible.
Yeah, I agree with you. It's very rare you're going to find a client that's just so far gone. There's nothing they can do. That's a big misconception I think a lot of clients have, is they think, hey, I've got so much debt I can't even do anything.
Right.
And I've talked with clients. I talk to clients every single day. I've talked to thousands and thousands and looked at I don't know how many credit reports over the years, and I could think of maybe one or two where it's like, wow, this is pretty tough. And sometimes bankruptcy or foreclosure is the best move for the client, and that's where they need to talk to a credentialed individual with regards to bankruptcy. Mm-hmm. But as long as the borrowers are willing to do a little bit of work, I think any mortgage professional and real estate agent that cares about their client is going to help them out. Yeah. And say, hey, here's some handholds. I know we're climbing Mount Everest here, but I'll make sure you don't fall off and die.
Yeah, exactly.
If you just do these simple things, we'll get up this mountain, Yep. Even if they're not a credit repair company, and I've got my different thoughts on that, but I really think if a client's willing to jump in, I think any professional in what we do is going to jump alongside with them and help them out, you know?
Well, I'll just say too, you know, to touch on that, in my opinion, credit repair companies aren't worth the money, you know? So if anybody's thinking about credit, be very, very, very careful. Most credit repair companies, I haven't found one, to be honest, that's worth their money. So most of the things that we're going to be teaching you today or giving you tips on today are the same types of things that you'll get from them, except they're going to charge you a whole bunch of money. And, you know, like we said, results, nobody can guarantee these results because credit's an interesting animal and you have to be patient with it and kind of do the right things over time. And there's no sense in, honestly, there really isn't sense, in my opinion, my humble opinion, to pay for those things. So hopefully, go ahead.
If I could add on to that just real quick, and I do get lots of clients that call me and say, hey, I'm involved with credit monitoring, and I think that's great. It's a good starting point if they just don't know who to talk to.
Yeah.
But when they've got a credentialed individual they can talk with that's experienced in helping people with that, with building credit, you know, example yourself or myself or other lenders out there that look at this stuff all day long, you can get their help for free.
Yeah.
They're willing to help you, and they're not going to charge you a subscription fee. And it is, you're absolutely spot on. We have lots of companies that come and want to get our, you know, credit repair stuff, and I have yet to find one that actually turns the client around. And I hate to say that. I wish I had a better solution, but a lot of the big and smalls, they call us, and it's unfortunate. I really wish I had someone I could endorse and say, these guys go at it.
Yeah.
And you know, it's just, I'd rather see you spend instead of spending $100 or $200 a month or whatever on their services, I'd rather jump in with you and say, hey, let's see how we can do this. Let's use that extra money and let's get a game plan together and use that money to pay off your debt versus paying somebody else to kind of put you on an autopilot system. So I agree with you on that. Now I want to bounce back, if you don't mind, Travis. We talked about rent versus buy, just to kind of help people get the big picture of why buying is an important thing. You know, you look at renting over 30 years, obviously you're not building any equity or wealth in what you're renting, right?
Right.
Mortgage payments going to somebody else is paying their mortgage. Right. Great for them, not good for you. But you look at, I just ran some fast numbers before this call. I always like to do this. I do this with a lot of clients. But, you know, you say 30 years, if you bought a home, a piece of real estate for, say, $350,000, we'll use that same scenario we used before, and you come in with, say, 3.5% down, or you use down payment assistance. There's lots of options out there.
Yeah. And
you kept that asset for, let's say, 30 years, whether you keep that specific home or you roll it into another home or whatever, that asset class over 30 years, appreciation, what's that look like in King County? Over the last 60 years, you're 5.125, right?
Yeah.
What's a typical financial advisor say, hey, this is what, you could grow your portfolio at? Most of the ones I've talked to say 6%. That's in the equity market. So looking at the real estate market, 5.125 for King County over the last 60 years. That's some really big ups and downs. Pierce County's about 4.125, fairly close right behind them. But, I wouldn't use the last 5 to 8 years as for your modeling, because we've had just phenomenal growth.
Yeah, yeah, crazy growth.
So definitely looking at those, shorter time frames, there's some massive growth that's happened, which is kind of an anomaly. But I like to look at the long term. What would things look like if I kept that home for 30 years?
Yeah.
Appreciation and time value calculation. You say take 350. You use a time value calculator. Say what's this thing worth over 30 years, 360 months. You're looking at about 1.6 million. Sounds kind of crazy to think about, but let's go talk to our grandparents when they bought a home 30, 40 years ago. What's their house worth? What's their home worth today? Yeah. And you're not too far off of that. Yeah. So that's kind of interesting to look at. Then you look at the cost of selling, say you sold it and you back that out. I mean, you may end up with, you know these numbers better than I would what it costs to sell, but just some quick math to get, if it's worth 1.6, you've paid the mortgage off by then, right?
Yeah.
You know, you're probably net somewhere around 1.4 million. That's crazy.
It's crazy.
I'm not a CPA, so here's my disclaimer. You need to talk to a credentialed certified public accountant or tax accountant, but my understanding is you wouldn't be paying capital gains on it because it is your primary residence.
Right.
Kind of cool. So there's some tax strategy planning there that's important to help you build that wealth. That's a conversation for another day. But just understanding getting into the game is the key. And just hanging in there, being able to maintain that payment over time, whether it's you or a tenant or roommates helping you out, kind of important. But that credit score is going to be really, really important. So,
well, and with how much rents are right now, I mean, it's in most scenarios, it's as good or cheaper to buy a home and pay a mortgage on a home than you're going to pay for a 2-bedroom or 3-bedroom apartment, you know. I mean, it's just, and then getting in is hard, man. You almost need better credentials now to rent than, I mean, it's wild. So it does make sense. And, you know, I couldn't agree with you more on that. So thanks for touching on that. And, you know, I think a lot of people it's a big purchase. It's a big thing to think about. It's probably the largest financial decision that most of us will ever make, buying a house. And
well, look at it as an investment. You're not just buying a car or you're buying something that's going to depreciate over time. This is a true asset class in your large portfolio of wealth.
Yep.
That's really important to look at it that way. Then making that payment every month, you say, wow, that's you know, yeah, I'm pushing the same as what I would be renting, maybe even less, as you mentioned, but you're not throwing it away.
Right.
You are buying an asset that will be worth something over time. And as long as you can hang in there during the ups and downs, you buy low, sell high is preferred, right? But as long as you can ride out those ups and downs and sell when the time's right, that's important. That's where the budgeting comes into play. This is all the credit. The stuff we're going to be talking about is helping you come up with a really good budget plan and, you know, managing your finances. If you can manage your finances on the credit report, you're going to be able to put the principles and strategies in place so that you can handle a mortgage and not stress out about it. You'll be financially set, and you know how to handle a credit card, you know how to handle a car payment, things like that. Take it on a mortgage, you'll have the right, I guess, the habits in place to handle the mortgage at that point.
It's good, man. Well, let's give the people what they're looking for, which is let's start to talk about the tangible tips and things that we can do. So I'll let you kind of lead that conversation because, you know, in the conversation we had the other day, you know, last month with our client, there were some things that I didn't know that really blew me away. And so, yeah, why don't you go ahead and get that conversation started?
Perfect. So I'll kind of touch on just kind of 3 main buckets, you know, starting your credit. How do you get it going? Cleaning up your credit. What are the derogatory issues we need to work through? And then the other one is just maintaining really good credit over time. Okay. So starting credit, I mean, some of the quickest ways to start credit are going to be through credit cards, revolving debt. It's one of the quickest ways to build and the quickest ways to destroy your credit. So if you're using that credit just right, it can really boost your scores in a really fast way.
So if I have no credit, I should go get a credit card, Ryan? That's scary, right?
That's crazy, right? Let's go get some debt.
Right.
Yeah, but I mean, really, in seriousness, you know, getting some debt is going to help you. Now, don't get sold by the car dealer. You need to go buy a fancy car and take out a car loan because that's going to build your credit to a lease. It's a sales tactic. Don't do it. You know, there's less expensive ways. Go and get a credit card, super easy one. Go to like the department store cards, you know, like Credit, Walmart. I mean, Macy's. Well, Macy's is probably not going to be around too much longer.
Nordstrom or
gas card, you know.
Yeah.
Places that you normally go, try to apply for those first. Okay. And you may get turned down. Don't be heartbroken if you are. That sometimes happens, especially when you're starting to build. That's okay. Apply for them. See if you can get 1 or 2 or 3. And then I'll talk about what to do with those cards in just a second. If you can't get one of those cards, you can go get a secured credit card. Jump online, Google secured credit cards. Make sure you do your research. Find out what the fees are, all that kind of stuff, so you know what you're getting into, and it's a legit company. questions, give me a call. Happy to help out. I'm sure Travis is as well.
Okay.
Secured credit card, what it is basically you're giving up your own money and you're borrowing against your own money. So say, for instance, you open a secured credit card, you give them, say, $300 or $100, and your credit max is going to be whatever you put up as your, secured funds, right? So say $100. You'll pay interest on your own money. You'll pay fees on your own money. Sounds crazy.
Yeah.
That's why you just get a small one. This is getting things started. Remember.
Yeah.
There's other ways you can do is get added onto other people's credit. A spouse or a significant other. That can help. Definitely more of a long-term play on that approach. But so getting things started with these two credit card options: the secured credit card or the just regular credit card through a department store or gas card, what have you. What you're going to do is
window. Sorry about that.
pretty basic. You'll get the card, open it up, okay? Go out and charge the card no more than 30% of the card limit. So simple numbers here. $100 balance, okay? That's the max you can have available balance you have to available limit. Don't go charge it up more than 30%, which is $30, right? Go put some gas in your car. Just watch that balance. Want to make sure it doesn't go over 30%. Can't stress it enough. A lot of people say, hey, well, 50%. I've heard this from that, the other thing. I'm just speaking from my own experience and working with clients. 30% seems to be the golden number. And we've ran all kinds of scenarios that way, and it seems to work out really, really well for our clients. So 30% of car limit.
Do you pay that the next, so you go rack it, you go put $30 in gas on your $100 limit card.
Yep.
Do you go then and pay it immediately, or you let a bill, like what's the strategy there?
Perfect. So strategy is you charge it up no more than 30%, wait for the first bill to come, pay half off. Wait for the second bill to come, pay it completely off, you're done. Don't close out the card, get it out of your wallet, just leave it in the safe at home, okay? You're gonna need it later, okay? So that's the startup strategy,
okay.
Right? Pretty basic. What it's saying to the bureaus is, hey, look, I've opened an account, right? It may hit your score and bring it down because you got a credit pull, but we're in the long-term planning stage right here. This isn't short-term, okay? So you get a ding on your credit, it's okay. It's the starting stage, but it's gonna ramp up. You're showing you can carry up, you're now using the card, okay?
Yeah.
You're carrying a balance and you're showing that you can make payments. Now that you've paid it off, you're now showing restraint that you have this debt available to you, this credit available to you of $100 or whatever the card is, and you're not touching that money, okay? That's good. That helps your score over time. When you have a couple of credits, say you had 3, 4, 5 cards. I've got some clients that have 9 cards. I'm not saying go crazy here, but they've got really good credit scores because they have 9 different creditors reporting to the credit bureaus that they're good on their debt. They have regard to making payments, and they meet their financial commitments. That's what you want. You want several of these things to really help you. So
how often do you pull it out of the safe and go do that again? How often do you do that? Once a month, once a quarter, what?
Great question. So I usually just tell clients 12 months because it's an easy number to remember, okay? And the reason why I do that is some creditors have a 12-month moving window. Sometimes they have an 18-month moving window or a 24-month moving window where they drop you if you're not using the card due to inactivity, right? Okay. We don't want that happening because it kind of ruins our plan. Right. So every 12 months is pretty safe. So if you opened it now, wait till next year, do the same thing, same process, okay? Charge it up no more than 30%, pay it half off, pay it completely off, okay? So that's the phases I recommend.
And it's really that simple. I mean, you don't have to do it only once a year and it's going to build your credit. Would it build it faster if you did it more than once a year?
You don't really need to.
Okay.
It's just a matter of time over that. As you start to get more credit added to you. So let's say you're in the secured credit card, you just can't get anything because you have no pulse on the credit report. So you need to get a pulse, right? Go get the secured credit cards and you're going to upgrade yourself. Go to your favorite department store, wherever you buy groceries from, grocery store, whatever, and get that card. Okay. Now you can leave the secured credit card till you start to get a couple, unsecured credit cards, what they call them, and start using those. So you have 2, 3, 4 of those. You can kind of let the secured one go away, so you don't have to pay those fees. I'm not a big fan of paying any more fees or interest than you have to, but yeah, it's pretty simple, Travis. You kind of stick with that game plan and your scores will go up pretty quick. And, you're probably talking, I don't want to you might pin me to the wall here, but you're probably talking 3 to 6 months, maybe. From a mortgage standpoint, we like to see good history. So sometimes, 3 months into it, you may not get an approval on your loan because you got thin credit. So if you have just one card, it's probably not going to do it for you unless you've had that card for 25 years or something for a long period of time. But if you're trying to get into a home, you really need to have some experience and longevity with that so it can show credit depth. And having multiple cards helps you get that as well. Okay?
So I've heard you say 3 or 4 cards ish, 5 cards somewhere in there. That freaks me out. I have a business credit card, but I have one actual credit card. And that's kind of been to my detriment. My credit score is topped out at a certain thing because I don't have enough enough creditors reporting. And yeah, I mean, if I want to get my credit score any higher than it is, I'm probably going to have to go get another one, which is ridiculous. But
it can be scary. It is daunting to think about. How do I want to open these credit cards? I want to be on cash only basis, and I get it. I don't like to have credit cards. I have a couple of them, and I do this strategy, and it works great. My scores are in the 800s plus, and it works really well. And I've helped my wife do that. I've helped close family members and friends do that, and it really works. Just be careful with the way you're using them. And I just can't give you enough heed and counsel on that. Just make sure you don't go and go crazy with those credit cards and let them get out of control. That's where you got problems.
Yeah.
Having several cards too, Travis, is important because let's say you do make a mistake and you forget a payment because you were out of town or whatever on one card. Well, say you have 4 cards, you got 3 other ones that are giving a positive feed to the bureaus, and you got one that you just made a slight mistake on, and that happens. And that can, if you just have one card and you make a mistake, it's like all that work just goes down.
That's good.
And it's sad to see that. We've had clients say, I did one card, I finally did it, and then they make a mistake and it just doesn't turn out well.
So go if you're just starting out, figure out a way to get a credit card. If you can get a few, as you might only be able to get one secured, and then you grow that into a couple unsecured until you get a few, 3 or 4 or 5 unsecured, and you're pulling those out once a year, and you're charging up no more than 30%. You're paying half off on when the bill's due. You're paying the other half the next month, and you're putting it back in the safe. That's a great way to build credit. Now, let's say you're like, yeah, Ryan, that's cool, but my wife wants a Nordstrom card, and she wants to put all the groceries and gas on it every month so that we can get Nordstrom bucks. We want the Nordstrom dollars or the American Airlines card or whatever. How do you balance using credit cards for the benefits that they give you without hurting your credit score?
That's an ongoing battle. I think that's something for the household. You have to decide what's best for you. Personally, my wife and I, we're not big. I mean, the points are kind of nice. So like big purchases, we'll make the purchase and we'll pay it off right away. We never make a big purchase unless we have the money there to pay it off right away. And I would never encourage you to carry a large balance. I mean, say you need to go buy a new dishwasher or something like that, or a new water heater, and you're like, hey, I might as well get some points here. And I mean, not a bad move. And some people live on their credit cards and pay it off every single month. There's nothing wrong with that. I just think it really puts you in a vulnerable position, and it makes it so easy to just swipe that plastic all day long. There's all kinds of different financial gurus you can listen to. I mean, I like Dave Ramsey. This isn't an endorsement or anything like that, so not an advertisement. But I like some of the strategies he teaches about, managing debt. And if somebody's interested in that, they may want to look a little deeper into those types of sources. But I really don't like the credit cards for living on. But if you need to get points, and that's important to you guys, then, is what it is. But
so if you pay a card off, you do that, you go out and you buy a new dishwasher or something, and you throw it on the credit card, and you pay it off immediately. It's not doing much to build your credit, but you're not hurting your credit either.
Yeah, you want to carry a small balance. What you don't want is, say your max is $5,000 on your card, and you go and charge up $4,500, right?
Right.
And then it hits the bureaus that you had a balance and you turn around and pay it off right away. Well, you don't want that because it's way over the 30% car limit, right?
Yeah.
What you want to do is if you're going to do that big bill, go charge it up. Charge it up to that max. Let's say in this scenario, $5,000 max on the card, and you bill it up to $4,500 because you bought whatever. Turn around and go pay it off, pay it down to where the balance is 30%. You just don't want reporting to the bureaus anything over 30% of car limit, right? So that's a strategy some people do. But does that answer your question there?
Yep. Yeah. And a balance occurs when we're talking balance. That's when you're paying like the minimum payment and you're carrying a balance onto the next month. You're paying what's required or maybe a little over what's required, but it's still, if you're carrying a balance above that 30% threshold, that's where you can get yourself into trouble. So that's good. Cool. All right. So what's next?
Well, yeah, I want to touch it. You know, sometimes when we get our credit going, we make mistakes. That happens. So let's talk about mistakes. How do we get out of them, right?
Yeah.
What are the typical ones we see out there? How do you kind of navigate some of those challenges? And I highly encourage you to talk to a professional that you know, someone you know, like, and trust that works in this arena, and they could get specific on your scenario. I'm going to touch some of the basics, a lot of the things we do see. So let's talk about late payments. You know, we get these credit cards, charge them up, we got late payments. What do we do, right? Different strategies with that. How do you get rid of those late payments? Sometimes it is, if it's a simple mistake, call the creditor, say, hey, you know what, here's the situation. Can you help me out? Give a one-time freebie forgiveness, and they could probably get that removed for you. Any of the stuff we talk about as far as cleaning up your credit, document. Make sure you've got all the paperwork to back it up, because it's not uncommon. You talk to somebody and they forget to make a note in your system and it doesn't actually happen. They probably aren't trying to be malicious or anything like that, but it just, some things, there's human error, right?
It's a good point. I make it a habit, and anytime I'm talking to anybody like that, I get their name. If they have their first and last name, if they have an ID number or a location number, because a lot of these call centers are all over the place, I would encourage that. You know, if you're calling and talking to creditors and they're telling you that they're going to do something for you, always get their first and last name, know who you're talking to, find out if they have an extension, find out if they have some sort of ID number, or, you know, where their location is or whatever, so that when you call the next, you know, you might be talking to a Houston call center, and then the next time you call in, you're talking to India. Well, they don't know each other, you know? Yeah. And so that's a good point. I think that's something I've learned to do over time when I'm talking. It doesn't matter. I could be calling, you know, AT&T for something. I do that because, you know, they'll say that they're going to do it, and then if they don't and you have to call back, you know, they're like, well, it's not in the notes. And so now now you might not get the same treatment. So that's a good point.
There's some little tactics to this as well. You know, when you're calling them, if you got a collection, you got a late payment, you know, what's that saying? You get more bees with honey.
Yeah.
Be nice to them. You know, they're getting beat up all day long. And I've helped clients. We've gotten on phones together, and, you know, I've just seen you get a lot more done that way. And, you know, they take good care of you. You know, if you need to talk to management, you know, be respectful of that. You know, get on there. I want to talk to your manager. You know, kind of chew them apart. They're probably gonna hang up on you. Then you're stuck in that 1-800 number call again. You got to deal with you've been waiting on for 2 hours to get to somebody.
Yeah.
So these late payments, sometimes they do turn into collections. Okay, so I've seen collections from, you know, Comcast bills, AT&T, you know. Medical bills, you know, all kinds of stuff that turn into collections, credit cards, car payments, whatever. How do you work through that? How do you get some of those things cleared up, right? Sometimes the only thing you can do is just make your payments.
Yeah.
One thing you could do is, and this is something for you to research deeper, so I don't claim to be an expert on it, but my understanding is that, example, medical collections. Let's talk about that. You know, say you went in for whatever procedure and you owe the doctor's office $1,000. A lot of times they sell those off at a discount. And I don't know the percentage of what the collection company buys them for, but my understanding, talking to different folks, is that it's quite a significant discount. So let's say, for instance, in this scenario, I go to the doctor's office, I have a bill for $1,000 for whatever it was. And it ends up going to collections, okay? Collection company's gonna buy it off the doctor's books, off their books for a discount, let's say 50%. So anything that collection agency collects is over that $500, that 50% is profit to them, right? Mm-hmm. But they reach out to me and say, hey, Ryan, we're gonna report to your bureau, your credit report, and to the 3 bureaus that you owe us $1,000 plus fees. Guess what? Those fees are $500. You owe us $1,500. Well, if I actually pay that full amount, they're making what? $1,000, right?
Right.
So if I can figure out, you don't really know what that number is that they bought it for, but it's open for negotiations.
You say, all I got is $500. I can take care of that right now. Will that work? And then they go, oh no, we can't do $500. Yeah. And then they come back, well, we could do 1,000. No, I might be able to squeeze out 700. And
I had one client tell me this, not suggesting to do this, but what he did is he called them up and said, hey, look, I know I owe you X amount, let's say $1,000. I've got $300. I'm trying to do right, trying to take care of my debts. And, but I'm also considering a bankruptcy. I don't know if that's the best strategy, but he ended up getting it for a heck of a lot cheaper. They're like, oh, well, this guy's filing bankruptcy and I'm going to be included in it. They know there's certain debts that can be included in the BK. Double check with your bankruptcy attorney on that. But yeah, there's certain ones that can be included that they know if you include it, they're not getting paid.
Yeah.
Or if we're going to get, if you do a debt restructure, that maybe they'll get a little bit. But so that's something to think about. Some strategies you can do is give them a call and maybe do some negotiations there. But whatever they agree to, make sure that you get it in writing. Say, hey, I'm happy to pay. So in my scenario, this fictitious scenario, about $1,500, and I get them whittled down to $800. Say, hey, listen, I'm happy to make that payment for you. I'll send it over. Can you send me a fax or an email that has my account number, my name, the balance that I owe, the $1,500, and what you're willing to take to satisfy the debt in whole. Get something in writing. A lot of times, this is what clients have reported back to me, because I don't make these calls. These are what clients are going to have to do. But they've reported back that usually the first person they talk to is not willing to do that. So escalate it. Hey, I'd love to talk to somebody that, maybe your manager that can help me out and talk me through this. Once you get to management, a lot of times they'll do it. And you can negotiate that. You can there's also a couple strategies on that. Let's say you want to get it removed completely from your credit report, that collection, right?
Yeah.
Or you want to get it zeroed out, okay? So 2 different things. If you get it zeroed out, it's going to report on the bureau again, on your reports, that it's a zero balance. A collection reporting is a collection reporting. $1,000 balance or a zero balance. Either way, it's hitting your score. So if you pay it off, it's probably going to hit the score again, which will likely drop your score. But it should report again after that. Okay, so usually your credit gets worse before it gets better when you're doing this kind of stuff. The other way you could do is say, hey, look, I owe you $1,500. I'll pay you the $1,500 in full, but I'd like a letter that says you're going to remove or delete this thing off my credit report once I've satisfied the debt. That's powerful. Costs more money to do it, but if you can get it removed completely, a lot of times, you're not going to see that. You'll never see that again, which is great. And your scores move up pretty quick from that. But it does, once again, cost a little bit more capital to do that.
Well, and I think that's great. One of the other things I would say too is if you're behind on payments, one of the biggest things is if you call people ahead of time, your creditors ahead of time, you can, because once it goes to collections is when that's when you're kind of really taking the shovel and trying to dig yourself out of the ditch. But if you can avoid collections, from a personal, I'll just share a quick personal testimony. When I was 21 years old, I was 1099, which is what I am today, but I didn't know what that meant back then. I didn't know that I had to pay taxes. I didn't know. I was used to being W-2'd, right? And it turned out I ended up owing the IRS like $3,000 or something. Nothing crazy, but at the time it was a lot of money, and still a lot of money. Shoot. And I called the IRS before they ever reached out to me. I mean, the guy kind of chuckled when I called him, but I called him, I was broke, man. I called him, I said, look, I owe you guys like $3,000. I literally can pay you 25 bucks a month. And they were like, okay. So they set me up on a payment plan for 25 bucks a month, and that's all I could do. But I stayed out of getting, that either having the IRS come and hit me with a bunch of penalties and knocking on my door or anything like that. And same things with creditors and collections. If you call those people ahead of time, like, look, I know I owe you money. I know I'm behind. I can pay you 10 bucks a month. I can pay you 15 bucks a month. I know that seems silly, but that can keep it from hitting collections. That can keep it from getting sideways on you until you can kind of get your feet back underneath you and actually make, bigger headway. It's not going to necessarily improve your credit scores and things, but it will help get you out of that ditch without having to go all the way into collections. So,
really good point. Thanks for sharing that. On the collections part or late payments part, this is one we see in mortgages a lot. So taxes go up almost every year, I think.
Yeah.
And we get a lot of clients that, well, not a lot of clients, but every now and again you get a client that doesn't get the notice from whoever their lender is that their taxes went up.
Their property taxes went up.
Those went up, which means their total payment went up a little bit.
Yeah.
And true story happened to me about 5 years ago. So, and I'm a lender. My taxes went up and I was deficient on my monthly payment by like $42. Well, I was paying $200 more each month, but the overage went to principal. Anyway, what I did is I called who was holding my loan at the time. I just called them and said, listen, guys, I've been making extra payments every single month. And, can we clear this up somehow? And can you take that late payment off? And they did. They gave me a one-time freebie. Usually they're going to be pretty cool about that, especially when the impounds, your taxes change.
Yeah.
So, give them a call, work it out, just like you're saying, Travis. But, they'll usually work with you a little bit. It's when it goes to collections, they get a little nasty, and it's really a little difficult to work that out.
So let's say I'm behind. It's not in collections yet. I'm behind. Those payments those late payments. I've got a few late payments on my thing. So we talked about credit. We said credit is the fastest way to build your, like credit cards and stuff is the fastest way to build your credit score. It's also the fastest way to tear it down. So, we've got a handful of credit cards. Some of them we have late payments on. Some of them we have good standings on. Mm-hmm. How do you recommend that we handle those? We got to we're caught up with we have late payments. We have late payment history, but we don't currently have late payments outstanding. And then we have other creditors that we don't have any late payment history and we're in good standing as well. But the ones that we have late payment history with are still dinging us. What do we do?
Travis, that's one. I love that you bring that up because we see that a lot. Yeah. And I mean, there's so many scenarios. It's hard to pinpoint every single one. So I appreciate you bringing some of these to light. We do see that a lot. Say you have 4 credit cards that are in good standing, or a car loan, student loan. You got a couple different things that are good. And then you have one that's just the thorn in your side. For whatever reason, when you were 16 years old or 18 years old, when you first get, I don't know when you first get a credit card, but you first get your card and you just totally ruin it. And out the gate, it's just been haunting you for years or whatever. That one, it's probably best just pay the thing off and close it out, be done with it. Move on from it. You learned your lesson, but keep the other ones in good standing. First and foremost, focus on these ones, keep them clean. And then whatever you have left in your budget, get this one taken care of as fast as you can, close it out and be done with it. Great question. So judgments, foreclosures, bankruptcies, those are all big topics under the derogatory area that do cause some major challenges in regards to getting a loan. So depending on the loan program, talk to your loan officer. There's some seasoning requirements there for those type of avenues. Chapter 13 bankruptcy or Chapter 7 bankruptcy, which one's best? Talk to your bankruptcy attorney or talk to your loan officer. They can kind of give you some things to think about there. But judgments oftentimes they typically have to be paid before we close on the loan. You can still get approved, but you got to take care of it for closing. Back taxes, we touched on that a little earlier.
Child support, maybe. stuff like
Yeah,
that.
child support, that needs to be up to speed because that is, you know, typically considered a judgment. You know, you look at things, what the lenders are looking for, what are things that are going to supersede our mortgage, right? So if the loan is for $300,000 and you got a tax lien of whatever, $5,000, that tax lien is going to supersede our mortgage, which means they can force a foreclosure if they did. They're going to get paid first, and then we get paid second. And the lender doesn't like that. They want to be in first position.
Yeah, yeah.
Especially if the loan's a pretty big one. So important for that. But I mean, that's really kind of some general things to focus on. Moving on to kind of our final topic, which is maintaining great credit. I mean, pretty basic stuff. Make your payments on time, right? I'd be careful to have credit inquiries. If you want kind of a review in regards to a mortgage world, how can I qualify for a loan? You can do your free credit reports and things like that, which are great. It's very important to know your scores are very likely going to be different on like a free credit report site, whatever you pick one. Even the free ones through the bureaus are typically going to be different than what an actual lender sees because it is a criteria-based inquiry. Mm-hmm. If you had your credit pulled for a car loan, a student loan, or a credit card, or a mortgage, we're probably all going to have different credit scores because it's criteria-based inquiries. You know, a lot of people call those hard hits, right? Yeah. They are hard hits on your credit. They do stay on there typically for about 120 days. So you want to be very careful with that. You don't want to go and have your credit pulled a ton of times. But if you're trying to buy a car or trying to buy a house or whatever, you probably want to talk to somebody and have them pull it for that type of inquiry so that they can give you a true, real feed on what the credit score looks like. And then they can really give you some handholds on how to get through the challenges that you may have, if you have any, right?
Yeah, you might be in better shape than you think. You know, that's one of the things I wanted to ask you about before we wrap it up here is, so, you know, one of the things, you know, the fastest way to repair our credit is credit cards, right? We talked about how to do that and talk about the 30% limit. I think that's super key. You know, if you have cards, if you have balances on cards, but they're not late, you want to try to eat into some of those balances. What I've heard you say before is like you usually, and this comes down to your specific scenarios. I think it's good to get with, like if you guys are watching this and you have any questions and you want to know specifically about your situation, you're thinking about buying a house and you're concerned about your credit, get with us and we'll do a conference call. We'd like, you know, Ryan can pull your credit and take a look at what's the most egregious things. And then we can say, all right, pay this credit card off first, then pay this credit card, then do this, because those are things that are specific to each individual and why it's important to have somebody on your side. Now, we can't guarantee the results, but these are things that we can help you with that will over time improve your credit. We've just seen it time and time again. What I want you to touch on real quick though, Ryan, is like, so there's that part of it, but then there's payment history, right? There's things like car loans or student loans or what do you, there's a name for them. What do you call them?
Yeah, so installment debt.
Installment debt.
What we call it. So car loans, student loans, those types of things. So from a lending standpoint, I mean, yes, you got credit score is important, but credit depth, we touched a little bit on that earlier. So if you've got like car loans, student loans, installment type stuff, or say you have your rents reporting on the credit reports, which some people do self-reported like that. Mm-hmm. That's really looked at by underwriting. They, you know, and I'm not an underwriter, but I do get the questions. What happened on this car loan, Ryan? You know, and I've got to ask the client, hey, you know, it's a pretty big deal. So credit cards, we can get through that. We know about that. We talked about that. But the car loans and student loans, those are the cousin to a mortgage. And if you can't make your car payment on time or your student loans on time, that's kind of a problem. It says the lender starts to think, okay, do you have regard to debt? Similar type debt, right? Are you making that boat payment on time? And if you go help you buy a house, are we going to be in that same, you know, scenario? Are you going to be making our mortgage payment? That's a big thing. So installment debts are really important, especially for that credit history to show, look, I can handle these types of payments. So
Well, an installment, if you miss an installment debt payment, you miss a car loan payment or something, or a couple, God forbid, right? Is that going to also really impact your score? Or can you kind of, is it possible to have a decent score because you're managing, you've done what we've told you to do on the credit card side of things, but you've kind of screwed up a little bit on some of the installment stuff? Is it possible to have a decent credit score, but then still not qualify for a home or have some issues because the installment, is showing that you've missed some payments? Or would that also really impact your score?
That's a good question, and it really depends on the individual portfolio and what they have going on.
Okay.
If they have one credit card and they've got 2 car loans, or a student loan and a car loan, and they mess up on one of these, yeah, it's going to impact it. Either way, you just don't want to have late payments, period.
Yeah.
But from a review standpoint of the credit history, really, you don't want to miss those payments on those car loans and student loans. Really, really important. You make those whole.
It's easier to recover. It sounds like it's easier to recover from late payments on credit cards than it is on installment loans. Is that fair to say?
Yep. That's true. So, what do they call it? An ounce of prevention is a pound of cure.
Right.
And just being smart, being careful about that. If you're like, boy, I think I'm going to have to miss a payment here, give somebody a call that works in that area of lending. Or your real estate agent that's experienced in that area, ask them what they think. And, they're going to probably give you, hey, this is what I've seen happen. They can't say I guarantee this, but they can certainly share that. There are some tools that we use on the lending side, which are called what if simulators, right? So we can pull a credit report, and if we've got a couple challenges on there, we're like, okay, what's the game plan? What do we do here? Travis, you and I worked with a client a month ago or so, and it was a pretty challenging file, lots of things going on, and which happens. And what I did is I ran a what if sim and say, what if we did this? What if we did that? Will it change the score? And it does take the lender a little bit of time to kind of do that type of work, but they can formulate a plan for you that could be very specific for building your credit score. And what it does is, let's say the score is a 600, right? And we say, we've got a car loan, we got a student loan, we have 2 credit cards, and we have, this credit card's balance is over 30% of the car loan. What if we pay it down to 30% or 5% or pay it off? All those different options. How's it going to impact the score? So we figure out, okay, if we pay it down to 30%, it pushes the score up, it gives us 5 points. Let's go play with the car loan. What if we do this to the car? What if we do this to the other credit card? The student loan. And kind of jockey that score up and down and try to figure the sweet spot that's going to give you the highest bang for your buck. Meaning spending the least amount of outflow out of your bank account to adjust and get those balances down to where it's going to give you the biggest credit score jump. Now, the lender can do, and is every time is it the most economical move for the client? Not always, but they can do what's called a rapid rescore, okay? Which is, let's say, for instance, we came up with a game plan and we pay this credit card down, we ran the what if simulator, it's going to give us, 60 points, right? That's a big jump. We've seen it before. And let's say we can get a 60 point by paying off that and removing a collection, okay? Give you the game plan, you go and do, you report back, provide us the appropriate documentation. We can then take that information and you can, one, wait for the bureaus to update on them on their own, which could take 30, 60, 90 days, depending on how fast those creditors report to the bureaus, or the lender can take those documents and they can push them to the bureaus directly, and which we call, doing a rescore. And they rescore within usually 5 to 7 business days is what it takes for a turnaround on that. This costs a little bit of money, so talk to the lender on what does it cost per trade line per bureau. And if you got 10 different accounts you're working with, you might want to just wait the time out.
Yeah.
But that's a little trick that you can work with.
Yeah. I mean, if you're that's a great point. I mean, we do that. If you're right at the cusp and it looks like there's a pathway to success that's fairly quick, we'll do that so you don't have to wait. We'll run that rapid rescore for you depending on your scenario. So that, I mean, you might be, I mean, those are scenarios where like you might be at 600 or 590 or 610 or somewhere just right, dancing right around it. And it's like, well, shoot, if we do this, this, and this, and this, which you're able to do, and we run a rapid rescore, you guys could be ready to buy a house in, 2 weeks or 30 days.
We do get the question, Travis, on, hey, I've got $5,000 in my bank account and I'm really trying to save up for my down payment.
Yeah.
I don't qualify right now because my credit's not there. What should I do? Should I hold on to the money or should I go clean up my credit?
Love it.
And, really the conversation, not every time, but a lot of the times it is, hey, let's get you in the best financial position possible so that you can handle a mortgage. And that you're not, at the end of the day, when you close on your loan 6 months, 8 months down the road, or even 2 years down the road, you're not like, man, this mortgage payment is killing me.
Mm-hmm.
It's really good to be, if we can become debt free or have that, that debt load under management, that's really where you want to be. And, I hate to have that conversation with a client when they call me 2 years later. Thank goodness I don't have that a lot, but we've had a few that have called us and said, hey, I want to go into a 15-year mortgage and the payment's way high and, they got all these other debts and they're like, okay, we can't handle this. And now we got to restructure things. But, really helping somebody build wealth through the vein of real estate or using that as a lever can be very, very powerful. And if we can help a client get to a spot where they don't have a whole lot of debt to worry about, taking on that investment payment into into a piece of real estate is something that we can help support them through. And there's obviously laws in place, the Ability to Repay Act that prevents lenders from pushing a client into a payment they can't handle. Well, aside from that, if you're taking care of your clients, you should be doing that anyway, right? There shouldn't have to be laws in place that say you shouldn't be pushing a client into a high mortgage payment. Really, that your professional should be helping you, coach you through that and say, okay, we've freed up this car payment. That's freed up $400 a month, right? You've got the money right now to either go for down payment, but you're going to be stretching your budget so tight, it's going to take you forever to get out of your debt. Why don't we pump the brakes on the home search? Let's go clear out some of this debt that's eating away at you, that's not bringing you any type of rate of return. Let's get that clear. And then let's start to build up your score or build up your cash reserves and then go and buy. There's a time and a season for everything. And sometimes the time may not be right now to buy or to invest, but you can certainly get to that point. And no matter how far gone you may think you are, there's hope.
Yeah.
Clean it up. And there's a way to do it, even if it is just putting an extra $10 a month towards your debts. And there are scenarios, live scenarios, we all know of some on this call now may have that, where it's just, you're like, I'm having a hard time just making my monthly payments. And we kind of get into a conversation of what are needs and wants. That's really important, to look at a family budget and our personal budget and find out what your needs are versus your wants. Do you really need that whole full cable package? Can't watch half the sports anyway right now, right?
Yeah.
Do you downgrade and go with just Hulu or whatever? Looking at those kind of things, what are things that you have that you really, really need and things that you think you really need, but are more just wants?
Well, I love that, man. I think there's a couple good pointers there, which is, if anybody is watching this and part of what I said in the beginning, is just figuring out where you are today. And if we figure it out, if we're working together, Ryan and I, and anybody we work with, we would hope would do this as well. Is we'll tell you, I'd love to sell you a house. Of course, it's what I do. But I don't want to sell you a house if it's going to make your house poor. And so it might make sense, we might tell you, hey, look, 6 months, if you take this $5,000 that you have here, good job, you saved some things up. Unfortunately, you got a little bit of a mess here on your credit report we need to take care of. If we do this, it will free you up and you'll get an extra $400 a month. If you buy a house now, you can buy a house now, but you're going to be strapped because you're not going to be able to get rid of that $400 a month as quick. If you can get rid of that $400 a month, it frees it up. We wait 6 months or even a year, we can buy a house, and now you're in a better financial space and you're not going to be stressed out. And there's a balance to that. And really what that comes down to is having a monthly budget. You know, if anybody's watching this doesn't have a monthly budget that you're really actively looking at every month, and being honest with yourself, there's a lot of people, they just don't even know. They're just paycheck to paycheck and they don't even know really where the money goes. You got to get honest with yourself. A lot of people are scared. I've talked to clients that, you know, I'm like, hey, do you got a budget? And they're freaked out about getting a budget because it means they kind of have to face the music, you know. But that is, if you're willing to allow yourself to be accountable to yourself, to face the music and just say, hey, it doesn't matter what it says right now. I need to know what it says so that I can make a plan to get to where I want to go. If you just ignore it and pretend that it doesn't exist, you'll be stuck in your same situation forever, and you'll be renting for the next 30 years. And you'll make somebody else $1 million, right, for the next 30 years as you rent. So I think that's huge. There's lots of great budget, you know, just Google free budget, you know, or if you want, you know, Dave Ramsey's I'm sure he's got resources on his site. We went through the Dave Ramsey class. We actually might be teaching it sometime next year, something that we're really passionate about. So that's another kind of that's a different conversation, but an important one to know is, like, you know, if you're digging in to try to get yourself healthy financially, you got to have a budget, because it's the only thing that's going to hold you accountable. And yeah, you're right. I mean, when we bought our house in Federal Way, it's like we quit CrossFit, we quit shopping at Trader Joe's. We found the cheapest ways to survive or to live because we really wanted this house, and we knew that some of the other things we had were luxuries. And so we did it. And then a few years later, you know, with income increases and things like that, we were able to go back to Trader Joe's and get a gym membership and things like that again. So, yeah, those are really good points. So anything else before we wrap this thing up? I mean, I guess I want to recap just real quick. I heard you say, number one, keep your credit cards under 30%, under 30%. Pay things on time. And if you are delinquent on things, or you've got some credit cards that are, you know, are maybe in rougher shape than others, get a hold of me, I'll get you in touch with Ryan, or somebody else that you trust, and we will sit down with you guys and help you figure out what strategy makes the most sense, right, to repair that credit. Pay your installment loans on time. If it looks like you're going to miss one, get a hold of one of us and let's figure it out. Let's walk it through and see what's the best scenario to mitigate your risk with that and your impact with that. And you know, last but not least, I mean, and this is probably actually first, get a budget. Get a budget, figure it out, but pick up the phone, give us a call. There's no judgment. We deal with people in all facets of you know, scenarios of where they're at with their credit, some with really great credit, some with not so great credit. But, you know, I found more times than not, a lot of times when you just look behind the curtain and actually deal with it, you realize, oh gosh, it's not quite as bad as I thought it could be. And now you have a plan to move forward. And that's the most exciting thing. You can't go anywhere without a plan. So with that, you know, unless Ryan, you got anything else, I think we could probably wrap it up. But I think this conversation's been super productive. I love this. I did not know about the 30% thing. I really didn't know how impactful installment loans were, honestly. And so that was hugely beneficial to me to learn just a month ago when I talked to you, to be able to share that with my clients. And I just wanted to have this conversation so we can, you know, people can watch it at their own time. So.
I appreciate you having me, Travis, and it's always a pleasure working with you. I love how much you put into your clients and really, I mean, do things like this and try to help them out. Last thing I'd probably throw into this, and this may be lead into another video mini series we do. But if you have decent, you think you have okay credit or good credit, you got a little bit of money in the bank, and you want to get rid of some of your debts to right size your budget, and you want to buy a house still, down payment assistance. It's an amazing lever, and we do a lot of Washington State Housing Finance Commission DPA programs, and that can be a real big lever to clearing some of the debt off, use your personal funds for the debt payoff, and we use the down payment assistance for your down payment. You kind of get the best of both worlds. So just another strategy there. We can talk at another time, but always great meeting with you. If you guys need anything, I'm always here to help out. Even if you have a lender that you know, like, and trust, fantastic. If you just need a second opinion or just want to chat, I'm always available. So Travis will have all my info, and thank you again.
Yeah, thanks, brother. Appreciate it. Yeah, if you guys have any questions or you want to discuss this further or figure out where you stand, give us a call me, and I'll get you connected with Ryan, and we'll do a conference call. We'll get it all figured out. And that's the most exciting spot is to figure out a plan to move forward. So thanks for anybody who's watching this. We appreciate you so much, and hope you have a great night.
Thank you again. Take care.
All right. See you, Ryan. Thanks.